I want to start off with looking at the comments that we had, and this is the seventh time we've seen a massive sell-off on the S&P, for instance, and that's engendered, of course, weakness right across the globe. I think we had equities at one-month lows, globally speaking. Now, the VIX barely moved. I mean, this is a story we've got right now, which is a bit perplexing, that it seems that investors are rather unperturbed amongst the sell-off. There's no panic out there.
That's certainly what it seems like to me. I mean, if we look at the months running up to this sell-off that we saw sort of the end of last week and last night, you know, we hadn't actually really seen that many investors putting risk-on assets in. I think we saw a bit of a rotation, and if you look at fixed income, some moves back into high yield, longer duration type exposures. But for the most part, in equities, investors have been buying defensive type proxies, minimum volatility, high dividend type investments, somewhat in technology space that's clearly been impacted by rates moving higher. But also, you know, volumes have been extremely low, right? So there is a real lack of conviction out there. And I think for us, you know, the Fed, Powell's statement, he didn't really tell us that much. So, you know, I think terminal rate is still kind of the same, but the expectation of pivot has now moved out slightly, which is impacting.
A go-in may come back on Labor Day, so maybe next Monday we'll see something, yeah? I don't know.
You never know, right?
I don't know how long holidays you take, but...
As you mentioned, nothing really changed, despite we saw this sort of summer rally, right? That June, you know, things were looking a little bit better about this Fed pivot or whatever. But is it going to be a complete unwind of what we saw? Is there more for it to adjust?
I think we'll see some adjustment, but again, I think it's mostly short-term positioning here. So you'd expect, you know, what we saw in June, July, I think was more around short covering as we sort of saw rate projections moving lower. For long-term investors, again, I don't think they've really been positioning for risk rallies. In fact, most investors that we speak to have sort of been sitting on the sidelines, wondering what to do and almost kind of panicking in this situation, because as markets have moved higher, clearly they've been underperforming in those 2 months. But where we are now, you know, I think investors are looking into the end of the year, but not really looking to take risk on. And that's kind of our house position as well.
And this isn't just a U.S. story, as Kathleen highlighted. This is also an ECB story now, this whole global tightening phase. You know, if you take a look at the U.S. 10-year, we're still hovering around 3%. Is that still optimistic in terms of an outlook?
I think it is a little bit optimistic. Again, I don't think the terminal rate has really moved that much. Forward projections on when we'll get a pivot is the main thing that investors are looking at the moment. And for us, I think the issue is that, you know, if you raise interest rates aggressively and don't pivot, then yes, you can quell demand. But, you know, this is really being driven by supply, right? So if you look at food inflation, energy, et cetera, these are really the main drivers. And raising interest rates doesn't really do that much for us. So
why are they doing it? I mean, you've got to question that.
Yeah, I mean, we look at the politics of inflation. You know, energy is a big thing, particularly for U.S. consumers. If you look between April and June, we saw about a 20% decline in the price of gas, and that kind of maybe gave the Fed a little bit more room to be slightly more dovish in their rhetoric.
Are we seeing any moves towards the demand side? Are we seeing any demand inflation, which is what monetary policy can deal with? And also to figure this, the nature of inflation is changing structurally. It's a long-term shift. I mean, we've got demographic changes on top of that. We've got the deglobalization and, of course, greenflation too.
Yeah, I think demand is slowly coming down as we expected as economies contract. On the supply side, you still have the issues with the labor market, you know, very, very tight labor market, energy, what's happening in Russia, Ukraine, food prices. So on the supply side, you know, I think long term this is going to be an issue. And I think the Fed will pivot eventually, but they won't do it until there's been a very structural impact in terms of growth in GDP. So by the time they do that, it might be a little bit too late in terms of the economy.
Is the dollar just the safest thing to go long on now these days? I mean, what sort of defensive strategy are you laying out in the next weeks or months? Yeah,
U.S. dollar has been the main sort of safe haven for investors. In terms of equities, it's been more into like minimum volatility type investments. Investors are looking at dividends. Japan has been very interesting, has performed pretty well. It's particularly topics, which is more sensitive to exports. And on the fixed income side, it's really just about duration. So investors have moved back into longer duration over the last couple of months, but I expect over the next couple of weeks they'll move back into sort of 1 to 3 year safe haven paper in the U.S.
Chavez, very, very quickly, I mean, when you get everybody on this program coming and being a dollar bull,
right?
And the currencies are notoriously difficult to predict. You almost start to think, you know, they get whipsawed the other direction.
Well, I don't really make predictions on currencies.
Of course not, I know.
But I mean, it's all going to be driven by what the Fed do, right? And also, if you get the ECB being more more aggressive than the expectation at the moment, then you'll start to see euro picking up and dollar coming down. So, who knows? I think U.S. dollar 20-year highs, it looks a little bit expensive, but it's a safe haven. So.